Everybody, it's 12:59, so hang tight for about 60 seconds, and we're going to start right on time at 1 o'clock. We just want to give everybody time to log in, but rest assured we are going to start here shortly. All right, everybody. It is 1 o'clock, so let's go ahead and get started. Looks like we have a good group on the phone, and I'm sure we'll get some stragglers coming on board as well. But what I want to do is thank everybody for attending. Today's webinar is our 1031 Exchange Advanced Strategies course, and myself, Leonard Spoto, and Matt Ferrencei are going to be your hosts for today. Before we get started, though, I want to make a couple announcements. So announcement number one, everybody who's on this webinar is going to receive an email when the webinar is done with a copy of all of the material. So all the PowerPoint slides you're going to see today, you're going to get an email sent to you at the end of the webinar with a link. All you need to do is download or click on that link to download all of the PowerPoint slides. Now, the second thing I want to mention is that these webinars are a lot more enjoyable for Matt and myself if you guys participate. And the way you participate in a webinar is you simply just ask a question if and when you have one. Now, if you don't have a question, fine. But if you do, all you need to do is type your question into the webinar dialog box. There's a little box there on your control panel for the webinar. It says questions. Just open that box up and then type your question in. It will pop up on my computer screen, and we will try to address your questions as they are pertinent. Now, if you're asking a question in the very beginning of a webinar and it's related to a topic we're going to discuss later in the presentation, I'll probably hold off to answer that question at a later point, but don't think I'm ignoring you. We will answer all questions and we'll stay on the presentation or the webinar as long as it takes us to get through all of the questions. Sometimes we get 1 or 2 questions, sometimes we get 30 or 40 questions. So just depends on the group and the day, it seems like, but we're happy to answer questions. We're scheduled to end at 2 o'clock today, but as I mentioned, we will stay on as long as it takes us to answer all your guys' questions. So first of all, let's also congratulate each and every one of you for taking the time out of your day to learn about this very important topic. It's going to help you if you are a realtor or an investor, and it's going to pay dividends over the long terms in terms of the knowledge you're going to get, the better ability to serve your clients, and also to help plan for your and your clients' investment future. So without further ado, what I want to do is introduce my business development manager, Matt Ferrencei. Matt is on the line, and Matt's going to walk you through a little bit of information about our company, Asset Exchange Company. So go ahead and take it away, Matt.
Thank you, Leonard. Yes, so we are a full-service 1031 exchange accommodator, and I work here with Leonard Spoto. And a little bit of background about our company. Asset Exchange Company was founded in 2006 by Leonard Spoto and Adam Skarsgård, who is a tax attorney. And since then, we've completed thousands of 1031 exchange transactions each year. So we've really seen just about everything when it comes to facilitating 1031 exchanges. So all kinds of unique circumstances. Now, as a 1031 exchange accommodator, essentially we all do the same exact thing. Our job is not to sell real estate. Our job is not to sell title insurance. We simply facilitate 1031 exchanges, meaning that our job is to hold the funds for you while you do your 1031 exchange, because you can't be in constructive receipt of your sale proceeds upon sale of the relinquished property. And we also properly document the transaction and ensure that you are in compliance with the tax code when you do your 1031 exchange. Now, where exchange accommodators differ is in regards to the quality of service that you are going to get when you work with one. So for us, we carry substantial errors and omissions insurance as well as a fidelity bond, which ensures that if we were to, say, make a mistake on the transaction that were to cause you financial harm, or say run away with your proceeds to Mexico, that you are covered for any losses that you incur on those on your transaction. And what I can assure you is that that has never happened with us. Otherwise, we wouldn't be around. But nonetheless, there is a safeguard in the event that were to ever happen. In addition, as I mentioned before, one of our principals, Adam Skarsgård, is a tax attorney. So we are also a member of the California Board of Accountancy and a member of the California State Bar. Now, for us, we also add an additional layer of support for our clients, and that is we provide free audit support. So if you were to, say, go with a different 1031 exchange accommodator and your transaction is ever audited by the IRS, more than likely you would have to go out and hire a very expensive tax attorney to represent you in tax court, and hopefully they know a lot about the 1031 exchange. However, more than likely, they would not know as much about 1031s as we do, simply because this is something that we deal with every single day and have done thousands and thousands of transactions for. Now, for us, although we can't represent you in tax court, what we can do is we can hopefully ensure that you never have to go to tax court by citing private letter rulings and looking up the requisite case law to substantiate the position that you took in your own 1031 exchange. And as Leonard will mention in the upcoming slides, it's incredibly important that you follow the rules when you do a 1031 exchange in the event that your transaction is ever audited, because there can be some pretty significant consequences if you don't. And with that, I'll turn it back to Leonard.
Yeah, and that's correct, Matt. So the consequences are significant. And, a lot of people call our office and they say, well, geez, what happens if, I get my audit and it just doesn't go well for me? I just pay taxes, right? Well, yeah, that's in the best case scenario, ladies and gentlemen. But more than likely, you're not just going to pay your taxes. You're going to pay your taxes. You're going to pay interest on those taxes and also penalties and fines. Now, if you really are egregious in your violation of the tax law regarding a 1031 exchange, you could also get sentenced to jail for tax fraud. Okay, don't believe me? Take a look at your computer screen. This unfortunately happens, ladies and gentlemen. Tax fraud is a criminal offense, and there are people in the past who have done 1031 exchanges, committed tax fraud, got caught, and got sentenced to jail. So take a look at your computer screen. As I mentioned, what I've done is I've pulled a press release from the U.S. Attorney's Office, the Northern District of California. And they actually detail a case here that was brought against Cheryl Savage, a realtor from Salinas, California, who did a 1031 exchange, went out and bought replacement property, but unfortunately immediately moved into that property. And then she tried to cover it up that she was living there by fraudulently reporting fake rental income on her tax returns. All right, that's a big no-no, right? You don't want to do that. You do that, you get audited, the government's going to take issue. They're going to say, wait a minute, you were living in this property, so why did you fake on your tax returns that you were getting rental income? Ladies and gentlemen, that's tax fraud. And tax fraud, as I mentioned, is a criminal offense. So what happened to poor Cheryl Savage? Well, the judge threw her in the slammer. She went to jail for 14 months for tax fraud related to her 1031 exchange. So the consequences can be steep, right? And believe it or not, we have people who ask us every single day, how do they do stuff like this, right? How do I cheat? How do I make it look like I'm renting the property out when I'm really not? Well, you just don't do that, okay? That's against the law. And if you get caught, you're going to have severe consequences. Now, ignorance is not an excuse, so you can't go to the government and claim, hey, I didn't know what I was supposed to be doing, right? Ignorance is not an excuse. One of the things that we are very good at, however, is letting you know what the rules are and making sure that you follow them, right? So we're going to be there every step of the way during your exchange, helping you be in compliance with these tax rules so you can avoid any really bad situations. All right. So very important that you follow the rules, and I'm glad you took a little bit of your time today with us to understand what these rules are for 1031 exchange. Now, before we dig real deep into the guidelines for an exchange, what we want to do is spend a little bit of time talking about some of the transactions that we have worked with investors on in the past, because they illustrate some very interesting points about the 1031 exchange process. So let's take a look at the Galaxy Office Park. This is the first building I want to talk about. It is a was a $42 million sale. It was a very large building, had several owners, and the reason why I like to talk about this property in particular is because when this building sold, there was $30 million of cash that was coming out of the property, right? They sold for $42 million bucks. They paid off some debt, and they had $32 million in cash coming out of the property. And while they were in escrow, one of the owners of the building called me up and said, "Hey, Leonard, when this building sells, can we take that $30 million and go park it in the stock market until we're ready to buy our replacement property?" Now, that's a good question. What do you guys think the answer to that is? The answer is absolutely not. Okay, when you do an exchange, you cannot touch the funds. If you are in constructive receipt of the sale proceeds, you are paying taxes. So it is very, very important, ladies and gentlemen, that when you are considering a 1031 exchange, that you get in touch with either Matt or myself to get an exchange account set up prior to the close of escrow. At the close, we are going to instruct the escrow officer to wire the funds to your exchange account. And those funds will sit in the exchange account until you are ready to buy replacement property. Once you're in contract, we will then wire those funds out so that you can close on the replacement property. At no time during the exchange can you direct, control, collateralize, or use those funds for anything other than replacement property. So can you invest your $30 million or your $30 from your sale of your property in the stock market? No, you absolutely cannot. Okay, the IRS is very strict in terms of the rules regarding your 1031 exchange. You've got a fantastic tax break available to you, but there are some hoops that you got to jump through in order to qualify. And one of the most important things is that you don't touch your money. So that's where Matt and I come in, my company comes in. We are the holder of those funds until you go out and buy replacement property. So think of it, ladies and gentlemen, like investing in your 401k, right? There's a bunch of rules regarding your 401k investing, but the benefit is that your investments are all tax deferred. But you need to work with a custodian, right? Charles Schwab or Fidelity, right? You guys are familiar with your 401ks. You have to work with a custodian. Well, for real estate, we are the same thing. We're a custodian for your funds until you are ready to reinvest. All right? So very, very important. Now, let's take a look at the second property here on the board. This is the Sandy Springs apartment building in Atlanta, Georgia. And this was a $26 million sale. And the reason why I talk about this particular property in all of my presentations is because it was owned by 27 individuals. And ladies and gentlemen, when it comes to 1031 exchanges, the IRS says that the taxpayer who owns the real estate is the taxpayer who can exchange the real estate. So if we have 27 owners of a piece of property, how many potential exchangers do we have? 27, right? So every single taxpayer who is on title to the property can potentially defer taxes by doing a 1031 exchange. Now, in this case, we had 27. And what's fantastic about the way this ownership was structured is that each individual coming out of the sale of this property can do whatever they wanted, right? You could have, 26 people decide to exchange and one person pay taxes. You can have one person decide to exchange and 26 people pay taxes. Doesn't matter, right? Because of the way this ownership was structured, you had each individual as a taxpayer of record for that property. Now, that is not always the case. So it's very important that you know, if you're a realtor, who the taxpayer is that owns the property. Sometimes the taxpayer is a person. Sometimes it's 26 or 27 people. Sometimes it is a corporation or a partnership or a trust. So the tax entity that owns real estate is the tax entity that can exchange the real estate. If the owner is a trust, then the trust will exchange. If the owner is an LLC, then who does the exchange? That's right, the LLC. All right, so very, very important, ladies and gentlemen. Keep this in mind when you're doing your exchange transactions. The taxpayer who sells is the taxpayer who exchanges and buys replacement property. So if an LLC sells, the LLC does the exchange and the LLC buys. If John Smith sells, John Smith is going to buy. The taxpayer who sells is the taxpayer who can exchange. Now, this last building here is the Armory building in San Francisco. And I don't know if we have anyone who is on the call from San Francisco, but if we do, you're going to know this building, right? This building is a pretty famous building in San Francisco. It was used for a pretty interesting business over the last several years. Well, this building got sold. It was a $65 million sale, and it was owned by one LLC. The LLC then went out and bought 30 replacement properties within 180 days. Okay, absolutely, perfectly legitimate, right? Very big transaction. It was actually a pretty simple transaction. There was only one owner. There's a lot of money that came out of that property, and they used all that money to go out and buy 30 replacement properties. So you could sell one property, you could buy 30. You could sell two properties, you can buy one. You've got the ability to do multi-property exchanges in the 1031 exchange process. All right, so let's now talk about why some of our investors are doing their 1031 exchanges. Well, the obvious reason is because they don't want to pay taxes, right? If you sell an investment property, you are going to pay about 1/3 or 33% of your gain to the government. So if you make $1 million in profit, expect about 1/3 of that, or $330,000, to go to Uncle Sam and the various taxing authorities. Now, of course, people who are looking to build wealth through real estate don't want to pay that. So they're doing exchanges because they don't want to give a big portion of their money to the government. And the 1031 exchange allows them to put that money that would have gone to the government into their pocket and use it to go out and buy bigger and better property. Right? Section 1031 of the Internal Revenue Code has been called one of the greatest wealth building tools available to investors. There is not another asset class that is as tax benefited as real estate. Okay, take a look at stocks, bonds. I don't care what you invest in. Real estate is by far the most tax-favored investment out there. You've got tax breaks when you own property, and you've got tax breaks when you sell the property, right? You're selling an investment property, you can defer the capital gains tax and use all of that money to go out and buy bigger and better properties. Now, some of our clients have been doing exchanges for a long time, and they've been investing for a long time, and they've got a really big portfolio, and they're very wealthy with their real estate holdings. Now, some of those investors are considering doing exchanges because right now they're looking for diversification with their real estate holdings. Right? Think about this, ladies and gentlemen. If you own $10 million worth of real estate in San Francisco and there is an earthquake, well, you could lose it all. If you own all of your real estate in an area that is prone to wildfires, which we're seeing happen almost every single year at really tragic levels, and if you own all of your property in one of those areas that borders on a fire area and there's a fire, you could lose everything. So what we see some of our clients do is they use the 1031 exchange to diversify. They get out of certain areas and go into different geographies, or they get out of certain types of property and get into different asset classes, or some of our clients do both. right? Some of our clients say, you know what, I'm going to get out of San Francisco. I own an apartment building there. I'm going to go out to Fresno and buy 20 single family homes. Okay, that works, right? Diversification will help you reduce your risk for a given return or help increase your return for a given risk. So people will use Section 1031 to diversify their portfolio, and they do it tax deferred. Now, the last reason why my clients are doing exchanges has to do with time. Two things happen over time. Number one, you run out of depreciation, and number two, you get sick and tired of managing your property. Both very good reasons to consider an exchange. Imagine you're 75 years old and you've been managing your apartment building for 50 years. Well, at some point you might think, geez, I'd like to spend a lot less time with my tenants and more time with my grandkids. Well, trade out or exchange out of that really tough to manage property and get it into something that you can manage a lot easier, like a triple net leased property, right? You go out of an apartment building and into a triple net leased Walgreens. You don't ever have to deal with that building. Walgreens takes care of everything. Okay, that is a reason you might want to consider an exchange. And then, as I mentioned before, over time, your property will become fully depreciated. And at that point, your CPA might pick up the phone and call you and say, hey, Fred, it's time to sell this property. Your depreciation's done. Get out of it. Get into a new, bigger property where you can get new depreciation schedules. All right. All of these very, very good reasons to consider a 1031 exchange. Now, of course, the most compelling reason is the fact that you can defer that capital gains tax liability. And ladies and gentlemen, very often people call my office and they say, well, geez, my tax bill's only 15%, right? So what's the big deal? Maybe I'll just pay it. Wrong. As I mentioned before, your tax bill is going to be about 33%. Now, how do I get that number? Well, your taxes are levied both at the federal and the state level. So the federal government's going to start you at 15%, but your rate will increase once you get above certain income levels. So your rate starts at 15%, but can go as high as 20% for the federal capital gains tax. You also will have a depreciation recapture tax. That is a tax on the amount of depreciation you've taken, and that tax rate is 25%. And then at certain income levels, which all of you are going to be above when you sell your real estate, the Medicare tax kicks in, and that is 3.8%. Okay, so these are our federal taxes, but wait, we live in California, so we're not done. We're also going to have the state tax, which is going to start at 9.3% and go as high as 12.3%, depending on your income. All right, so when all is said and done, when you blend all of these taxes together, at the end of the day, you're looking at a tax rate of about 33%. Now, 33% of what, you might ask? Well, 33% of your gain. A lot of people call my office and say, well, Leonard, I sold my building for $1 million and I paid off my mortgage of $950. After commissions and closing costs, I don't have any cash. So if I don't have any cash, I don't have any tax bill to pay, right? Wrong. The debt that you have against your property has nothing to do with your gain and your ultimate tax liability. Okay? Your tax is based on how much gain you have in the building, and gain is a function of your sale price minus your basis. All right? That is important to know. Sale price minus your basis. But you might be thinking, well, geez, Leonard, what the heck is a basis? Well, the basis in your property is your purchase price minus your depreciation plus your capital improvements. So let's do a very quick example here. You went out and bought a property for $500,000. Over the years of ownership, you have taken a total of $100,000 of depreciation. You had to put a new roof on, which cost you $25,000, and you are now in contract to sell the property for a net sales price of $1 million. And when I say net, what do I mean? I mean after commission and closing costs. Okay? So if we have those set of circumstances, we can very easily figure out what our tax bill is going to be. The first thing we're going to do is figure out our basis. Our purchase price minus our depreciation plus our improvements. That gives us a basis of $425, and if we use that basis, we can easily figure out that we have a gain of $575,000. That's our taxable gain. Nowhere in these calculations do I need to know how much debt you have. That does not factor in to the circumstance. Now, the gain is $575, but your tax on that gain is going to be about 33%. So the CPA is going to crunch the numbers on all of those taxes we talked about before and come up with a number that is very close to 1/3 of your gain. Right? Your gain was $575. When the CPA did his or her number crunching, you've got a total tax liability of $192,000. Now that is very common, right? We see clients who have $200,000, $300,000, $400,000 worth of tax liability every single day here. Now the fantastic thing is you've made some money, so of course you've got some tax bill to pay, but the fantastic thing is you don't necessarily have to pay it. As I mentioned earlier, real estate is the most tax-advantaged investment out there. And the tax break that you get depends on the type of real estate that you sell. So, 2 pieces of tax code that everybody on this call need to be aware of. Number 1, Section 1031 of the Internal Revenue Code. That is tax deferral for your investment property sale. This is what my company deals exclusively with. All right? That is just one piece of the tax code, however, that you need to understand. The other piece of the tax code is Section 121 of the Internal Revenue Code, and that is tax avoidance on the sale of a primary residence. Right? So if you're a realtor, almost every single property that you close on is going to either qualify for this or this. Now, there are some properties you could sell that won't have any tax advantage when sold. Can anyone think of what type of property you could sell and have 0 tax benefit? How about this? How about a second home? You own a property in Palm Springs, okay? You have never lived in it and you have never rented it out. Well, those second homes, unfortunately, ladies and gentlemen, when you sell them, they are fully taxable. If you don't want to pay taxes on your second property or your second home in Palm Springs, you either need to move into it or you need to rent it out. All right, that's how we qualify for tax breaks on the sale of real estate. Now, very important, ladies and gentlemen, as I mentioned, Section 1031 for your investment property, Section 121 for your home. Section 1031 is tax deferral. Section 121 is tax avoidance. Now, is it better to avoid paying taxes or defer paying taxes? It is always better to avoid, right? Avoiding taxes means you just don't have to pay them. Deferring taxes means you don't have to pay those taxes today. However, once you stop exchanging, guess what? Well, you pay taxes. As soon as you stop exchanging and you cash out, you put the money in your pocket, you pay taxes. And ladies and gentlemen, if you are a successful exchanger, like all of you are going to be, you're going to have a huge tax bill to pay if and when you cash out. That's a good thing because you've been successful, right? You started off with a 2-unit building and you did an exchange into a 4-unit building. You sold the 4-unit building and you bought a 10-unit. You you sold the 10-unit building, and now you've got a 35-unit apartment building. You've never paid a dime to the government on any of these transactions because you've done an exchange each and every time. Fantastic. The problem, however, is now you're 75 years old and you're thinking, well, geez, this 35-unit apartment building, I want to cash out. I'm done. No more real estate for me. All right, that's fine. You sell the building, you pay taxes on that building and every single other property that you've done. So over the course of your 20 years of investing, you've done 4 exchanges, and now that you've stopped, you pay taxes. Not the end of the world, right? But the problem is you've been so successful that you have a $1.7 million tax bill. And you think, well, geez, I don't want to pay it. Of course you don't. Who wants to pay $1.7 million to the government? Not me. So what do? Well, you just don't cash out. All right? You don't sell that apartment building. If you're sick and tired of managing it, you can exchange out of it and into something that you don't have to manage. And then you're going to own your triple net leased Walgreens until you die. Ladies and gentlemen, take a look at your computer screen. This is one of the most powerful things we're going to talk about today. The 3 Ds of investing. All right? You're going to defer, and then you're going to die. When you do that, all of your capital gains tax dies with you. Let me say that again. When you pass away, all of your capital gains tax dies with you. It goes away. Now, technically what happens is your kids are going to inherit the property at what's called a step up in basis. So remember that math that we did a few slides ago where I showed you how to calculate your basis? And essentially, if you have a low basis and a high sales price, the difference is taxed because that's all the gain. Well, guess what? When you kick the bucket, your basis steps up to fair market value. So if you bought the property for $100,000 and it is now worth $5 million, the difference for you is gain, and that's taxable. But guess what? When you die, your kids will inherit the property and their basis steps up to $5 million. So if their basis is $5 million and they sell the property the day after your funeral for $5 million, how much gain do they have? 0. So absolutely no capital gains tax. Okay, that is astute planning. That is a fantastic way to pass on wealth to future generations. Hey, you don't have any kids? No problem. You can nominate me to be your heir. When you die, I will inherit your property, and I'll sell it the day after your funeral and pay no taxes. Very, very, very astute estate planning. All right. Adolfo says that he cannot hear me. Is there anyone else having problems hearing me? Hopefully not, but if you are, you might need to redial in. I'm assuming if you can't hear me, you're not going to know that. Okay, ladies and gentlemen, what I'm going to do now is we're going to dive into how to structure your exchanges. All right, how do you structure those exchanges so that you avoid any problems with the IRS, you avoid tax fraud, and the person who I'm going to ask to rejoin me to talk about these steps, these guidelines for a successful exchange is our buddy Matt. So Matt, why don't you get back on the phone and walk us through the 4 guidelines for a successful 1031 exchange?
Absolutely. So when it comes to doing a successful 1031 exchange, there really isn't a whole lot that clients actually need to know because we're here to help facilitate everything. But there are 4 basic requirements that you have to keep in mind if you want to have a successful 1031. And the first is that the properties must qualify. The second is that you have to keep in mind your tax deferral requirements. You also want to keep in mind your exchange timeline and your identification rules. So let's go over those. Now, the first guideline is that the properties involved in the exchange must qualify, so they need to be used for business or investment purposes. So if you've had an investment property, you want to make sure that you rent that property out for ideally 1 to 2 years before you exchange, preferably 2 to have a clean transaction, and then exchange into another investment property. Now, the properties involved also need to be like kind. And if people hear the term like kind and they think that it means you have to sell the one type of property and then purchase the exact same type of property. So if you have a single family residence, you have to purchase a single family residence. Not the case. You can sell an office building and purchase a piece of land. You can sell a piece of land, purchase a single family residence, or even sell a single family residence and purchase an office building. The type of real estate does not matter so long as it is in fact real property and that it is used for business or investment purposes. Now, there are a couple of exceptions to this. One thing that does not qualify is known as foreign property. So if your goal was to sell your duplex in California and then purchase a investment property somewhere in Monaco, unfortunately, it sounds pretty great, but you cannot do that. It has to be located within the United States. However, it could be anywhere. It could be Texas, it can be Montana, does not matter. And the second thing that does not qualify is known as a quick flip. So if you sell your investment property and then you decide to purchase a replacement property, flip that property, make improvements to it, and sell it immediately afterwards, that will not qualify for 1031 either. We have clients ask about this all the time. And the reason is that quick flips constitute inventory. They don't constitute investment. And that's because with the quick flip, what you're doing is you're not actually making money off of the appreciation of the property or the income generated. You're simply making money off the improvements that you're making and then from the sale. So it doesn't mean that you can't ever make any improvements to a property, but if the goal is just to purchase it, improve it, and sell it, that will not work. So something to keep in mind when you sell your own property and do your 1031. And the second guideline is tax deferral requirements. When you sell your investment property, if you plan to defer 100% of your tax liability, you have to purchase replacement for equal or greater value to what you're selling, and then reinvest all the cash from the sale. So if you have a loan on the property and you want to purchase a new property, then you either, have to replace that loan or contribute additional cash out of pocket. How it works doesn't matter so long as you reinvest all the cash. So if you sell for $1 million and you want to defer 100% of your tax liability, you need to purchase at least $1 million worth of real estate or greater. Now, we get asked all the time, can you trade down in value? So can I sell for $1 million and then purchase for $900,000? The answer is you can do that. You can trade down in value. However, the difference between what you sold and what you purchased is subject to capital gains taxes. So in this example, you have a $100,000 delta between what you sold and what you purchased, and that $100,000 is taxable. And you want to be careful because when you trade down too much, you want to know how much gain you have in the property, because if you trade down in value too much and take too much cash out, you could potentially take out all of your gain and you'll be taxed on all of it, and it essentially makes doing a 1031 exchange pointless. So talk to your CPA to ensure that you know how much gain you do in fact have.
Yeah, hang on, and let's talk about that just a little bit more. So Matt said, if you trade down too far in value, your exchange might be pointless, right? And here's a good example. You sell for $1 million, you buy for $900. So the $100,000 difference is taxable. Well, what happens if you only had $100,000 of gain anyway? Well, your exchange was pointless. There was no reason to even put yourself through the hassle because you were paying all your taxes anyway. So it's very important to do a little bit of math before you get into this scenario to understand what your gain is and what you need to buy for. Obviously, we're here to help you out with that too. We can do some quick math for you. It's not too complex, but we've had people who've traded down in value in the past, and they thought that it was going to be all right, and it wasn't, because they ended up going too far down and paying all their taxes. So very, very good point, Matt, and I'll hand the mic back over to you.
Yeah, thanks, Leonard. And so the last guideline that we have when it comes to, the third guideline that comes to 1031s is with regards to the identification timeline. So when you close escrow on the sale of your investment property, you have 180 days to close escrow on the purchase of your replacement property or properties. Now, we get asked all the time, can we get an extension on that timeline? And unfortunately, you cannot. Unless there is a presidential disaster declaration in the area affecting the properties that you're purchasing, you won't be able to get an extension on that timeline. Now, for us in California, as many know, we've had a lot of fires in the last year or so, and we have actually worked with a lot of people who have had extensions on their timelines because these fires have affected their properties, unfortunately. But for your purposes, don't plan on there being a presidential disaster declaration in the area of your property. Consider this timeline to be airtight, even in the most difficult of circumstances. Now, the second guideline, the second part of the timeline is the 45-day identification period. When you close escrow on the sale of your property, you have then 45 days to identify your replacement properties. You don't have to be in escrow on these properties. You don't have to even be in contract, but you need to know which properties you intend to choose from by day 45. So by day 45, you need to send a letter to us saying, here are the properties that I am going to choose from when I exchange. Once day 45 passes, you can no longer amend your ID letter, and that list is final. So make sure you plan accordingly with your realtor so that you know what's on the market and what you want to exchange into. That way, you don't hit day 45, you don't know what you want to purchase, and then afterwards you can't, in fact, get a hold of anything. Because before day 45, you can actually amend your ID letter. So if the properties you've identified, say by day 30, all of a sudden they're in contract, somebody else purchased them, well, you still have 15 days to identify more properties to choose from. So there's still some time. Just keep in mind, once day 45 passes, that list is final. And with that, it actually brings us to the last guideline, which is the identification rules. When you ID your properties, you can actually identify as many properties as you would like. However, there are a couple rules that govern how those properties are ID'd. And the first is known as the 3-property rule, and the second is known as the 200% rule. Now, with the 3-property rule, you aren't restricted by the value of the properties, but you are restricted by the number that you can identify. So with this particular rule, let's say you sell one property, you'd want to identify 3 properties. Well, those 3 properties can be of any value, and of course, any property type as well. So you sell for $1 million, these properties could be worth $10 million each if that's what you're looking for. Value is not an issue. However, if you want to identify more than 3 properties, say you want to identify 4 properties or 100 properties, that changes the rule that you are going to use. And that brings us to the second rule, which is known as the 200% rule. Now, with the 200% rule, you can identify 4 properties or greater, up to as many properties as you would like, so long as their combined value doesn't exceed 200% of the value of the property you're selling. So let's say that you sell an office building and you want to identify 5 single-family residences to exchange into and rent out. Well, you can do that, but the combined value of those 5 properties can't exceed $2 million because that is 200% of the value of the property that you sold. So with this particular rule, you aren't restricted by number, but you are restricted by value. And it's important to know these rules in advance. That way, when you or your clients decide to exchange, you can have a sense of what your reinvestment criteria is. Do I just want to exchange into one really large property to produce a greater return on investment, or do I want to spread my risk across multiple properties? It really is dependent on the client and what they feel is appropriate for them. But these are the 2 rules that you have to keep in mind. And that's essentially it for these rules. So once again, the 4 guidelines are that the properties must qualify. Keep in mind your tax deferral requirements, your 180-day purchase timeline, and 45-day identification period. And then lastly, your ID rule. So that's the 200% rule and the 3 property rule. And you guys will essentially be good to go on your 1031 exchange. And with that, I'll hand it back to Leonard.
Yeah, thanks, Matt. And there's a lot of nuance to the tax law, and there's things that come up that can affect transactions. But if you know those 4 guidelines, you're going to get through about 90% of the exchange scenarios out there. And then, of course, we're going to be on your beck and call to deal with any other type of issues that can come up. I'll give you an example. It is very difficult to do an exchange with a related party. The IRS has related party rules, and they make it very difficult for you to, for example, sell a property and then buy replacement property from your mother or your brother, okay? But those don't come up very often, and when they do, we're on hand to kind of deal with those situations and to make sure our clients are in compliance with the tax code. I think some of the most challenging parts of the exchange are going to be those time frames that you're dealing with and your ability to find suitable replacement property. Okay, so remember, you've got 180 days. Those days go quickly, but really you only have 45 days to figure out what you're going to buy. So finding that suitable replacement property is going to be a challenge. Now, my recommendation to you is when you put your property up for sale, you're going to want to immediately start looking for what and where you want to buy. All right, remember, your 1031 exchange time frame starts at the close of escrow. All right, but you're going to get into contract usually 30 days prior to the close. All right, so you're going to have a period of time where you're in escrow for 21 to 30 days, and during that time frame, you can start making offers on replacement property. Okay, so you are fantastic if you go out, get into contract on your sale, and then immediately start looking for replacement property, get into contract on something, close escrow on your sale, and then the next day or next week you close escrow on the purchase. All right, a lot of our clients do that, and it is going to be very helpful if you just do your homework, do your due diligence, get out there, start looking for suitable replacement property as soon as possible. Now, a lot of our clients will ask, well, geez, what if I find my replacement property now and I want to buy it now? Can't I do that? You can. It's called a reverse 1031 exchange. And in a reverse exchange, instead of selling and then buying, what you do is the opposite, right? The opposite is buy first and then sell. So you could close on your purchase property, and then within 180 days, if you sell, that sale will be tax deferred if you structure it as a reverse. So everyone's thinking, oh, this is fantastic, I'll just do that, right? Well, it's a little bit tougher because in a reverse exchange, you are going to buy this property and then sell this one. All right, so you're buying the replacement property, and then you hope to sell what we call the relinquished property. Now, the problem with the reverse exchange, ladies and gentlemen, is that you, the exchanger, cannot own the new and the old property at the same time. So the way that reverse exchanges are structured is my company will come in and become the buyer of the replacement property for you. Let me say that again. In a reverse exchange, we become the buyer of the replacement property on your behalf. Once you sell your relinquished property, we then transfer the new property to you. All right, so there's a bit of a shell game going on here. So you can't own them both at the same time, so we will buy this one for you. Once you get your property sold, you can now take title to the property, the replacement property. Now, anyone think of any problems with that? Problem number one, do you have any money to pay for this property? You haven't sold anything, and I'm not going to use my money, so you need to come up with some cash to buy this. And you think, well, I've got some cash and I'll just get a loan for the rest. Well, these deals, these replacement property transactions are extremely difficult to finance. Lenders do not like to loan you money when my company is taking title, right? Some of them will, but they're going to charge you more. And then the other issue is that when I become the straw buyer initially, there is a transfer tax. And then when you sell your building and become the buyer, there's another transfer tax. So these deals are more expensive. There's duplicate transfer taxes, and they're very difficult to finance. With that said, however, given all the complications, we still do several reverse exchanges every single month. We don't do a ton of reverse exchanges. Out of the 150 deals that we do every single month, maybe one or two are reverses. My advice to you, if you're calling about a reverse exchange, my first recommendation will be, can you avoid it? And if the answer is no, then we will say, okay, well, here's what it's going to cost. Here are the complications, and let's see if we can get past those issues to get it done. Does that make sense? All right. So that is the reverse exchange, ladies and gentlemen. And with that, we're going to go ahead and open it up to question and answer period. We've got Wes from San Rafael asking a bunch of questions. And please do stay on. And if you, like Wes, have some questions, type them in, and we're going to go ahead and run through your questions. If you need to get off the call now, we understand. But please do give us a shot on your next exchange, all right? If you have questions, you can call myself or Matt. We're available at the toll-free number or our email. You can call or email us anytime. And please, please, please do use us as your accommodator, all right? We will do a fantastic job for you, I promise you. And with that, I'm going to go ahead and answer some of the questions that Wes has asked. Now, one of Wes's question is, well, what about debt relief? Debt relief is when you don't take on enough debt on your replacement property. All right. So if you had $500,000 of debt on the sale property, generally what you will do is take on $500,000 or more worth of debt on the replacement property. But what happens if you don't? Well, debt relief is taxable unless you contribute additional cash out of pocket. So let me give you an example. You sell a $1 million building with $500,000 worth of debt. You buy a $1 million building and you only have $300,000 worth of debt. Well, that's okay because you put down $700,000. So you added cash to the transaction. Cash is king, ladies and gentlemen, and cash contributed always offsets debt relief. All right, another question from Wes. Can I trade 3 rental condos for one in San Diego? Absolutely, you can do that. But now Wes says, well, geez, what I want to do is rent that San Diego condo out for a while and then occupy the San Diego property as my primary residence. Can I do that, ladies and gentlemen? It's possible. Now, Wes, in order to be compliant with the tax code, when you buy your San Diego property, okay, you're going to buy in San Diego. What I want you to do is I want you to rent it out for 2 years minimum. And I'm going to say 2 years because A, we're in California, and B, you know you want to move into it. So in an audit, I can defend you if you've got 2 years of rental income on that San Diego property before you move into it. Anything less, I'm going to have a real hard time defending you if you're audited. All right? Okay, another question. If I own an apartment building in an LLC with my siblings and I want to sell and do an exchange and go our separate ways, do I have to take the property out of the LLC for a specific amount of time before I exchange individually? And the answer to that is yes. So remember, the taxpayer who sells is the taxpayer who has to buy. So if you have an LLC selling, who has to buy, Wes? The LLC. Now the problem is the LLC has two people, right? We've got Wes and we've got Wes's brother. The problem for Wes is he wants to get out of business with his brother. He doesn't want to own the replacement property with his brother. So what Wes is going to have to do is he's going to have to drop the property out of the LLC and put it into his name and his brother's name. And then he's going to want to season that ownership for at least a year or two before he sells it and goes out and exchanges individually. So very good question, Wes. We call that a drop-in swap. Again, here in California, the IRS has told us that they want to see, the Franchise Tax Board in California has told us that they want to see that ownership, that individual ownership, seasoned for at least a year or two before the exchange transaction occurs. So it's no longer good enough to drop out of the LLC a week before you sell the property. You want to season that apartment building on your individual tax return for a year or two. Okay, very good question. And it looks like we have one other question that has come up from Singh. Singh wants to know, after I exchange, can I use the property as my primary residence? And we kind of touched on that with Wes already. The answer to that is absolutely not. You need to rent it out for at least 2 years first. And then Wes is saying, would that be individual ownership for calendar years or tax years? Okay, very good question, because a lot of people try to get sneaky or tricky with the auditors and say, well, geez, I owned it for December in my name, and I owned it for January in my name, and then I sold it in February. Now, the auditors are going to look and say, well, that isn't going to fly. What they want to see is 2 full years of rental income, 24 months if you can, right? So let's say you switch ownership at the end of the year. That's fine, right? You switch ownership out of the LLC into your name in December. Well, you're going to file all of the year for the property in your name. But then you go into the next year, you want to have 6, 8, 12 months of rental income. Okay, the longer, the better. All right, one other question here is, after I rent the property out for 2 years, can I move into it? Do I need to pay taxes when I move into it? No, you don't. You only pay taxes when you have a liquidating event. If and when you sell, that's when we're going to look and determine if you pay taxes or if there are any tax breaks available to you. Simply moving into your rental property is not going to trigger a taxable event. All right. Adolfo, Adolfo wants to know, can you provide an example of capital gains tax due after the investor has done a couple 1031 exchanges and decides to sell? Sure. Okay, you have a 2-unit building and you bought it for $100,000. You sell it for, let's say, $500,000. So how much gain do you have? You got $400,000, right? You're going to go out and you're going to buy a new property, a 4-unit building, and you're going to pay $500,000 for it. Okay, now you're simply going to cash out and sell the property for $600,000. You have $100,000 of gain in this property. So now that you've stopped exchanging, the $100,000 is taxable, as is the $400,000 that was your first exchange. So you've got $500,000 of total gain that is exposed to tax liability. Very good question, Adolfo. All right, one last question, and we're going to go ahead and wrap up. Singh says, I moved into the property as my primary. I lived there for 2 years. Do I need to pay taxes once I sell it? When you move into a rental and you sell the property as a primary residence, you are able to shelter the gains that are allocated to the ownership when you move into a rental and you make it your primary residence, you then sell the property. Your gain is going to be prorated between the time that you lived in it and the time that you rented it out. All right? So take a look at the board saying you rented a property for 2 years. You then lived in it for 2 years. The gains from the 2 years that you lived in it are going to be exempt. The gains that are allocated to the 2 years that were rented, these gains are going to be taxed. So it gets a little bit confusing. The gains allocated to the rental years are taxed. The gains allocated to the primary residence year are exempt from taxes. Make sense? All right, ladies and gentlemen, thank you very much for spending an hour with us today. Matt is available for further consultation. I am available for further consultation. If you have any further questions, give us a call. Matt's going to answer the phone, and he is going to make sure that you have all of your questions answered. Again, look forward to working with all of you on your next 1031 exchange. Signing off, Leonard Spoto and Matt Ferrencei. Have a fantastic day, everyone, and we look forward to working with you very soon.
Take care, guys.